Hey, this week I got to talk with Elizabeth Yin from Hustle Fund. She's a partner there. Before that, she led 500 startups during the time that I was there back in 2016, 2017. And before that, she was a startup founder. She's literally one of my favorite VCs of all time. And we had one question for her today, which is, why does fundraising suck so bad for founders? Hope you enjoy.
So I did plan on having a conversation with you today that was on a separate topic, but I keep running into this problem that I've hit with, in the past 3 weeks, 3 different founders. I keep on hitting the same sort of problem around fundraising in particular. And I thought, oh, who better to teach this topic than you, because you were actually the one who taught me how to fundraise. At 500 Startups in batch 17, you led that whole process of fundraising Hell Week. And so I thought, oh, I would love to hear your thoughts on this. But before we do that, first off, what you taught me, tell me if I'm wrong, what you taught me in terms of how to raise your first kind of institutional investment was principle number 1 is you have to have a really wide funnel, right? Which is like, you need to talk to a lot of investors. And that's the only way for you to have leverage as a startup, is that you have to have a bunch of people you're talking to so that some of them will get FOMO and want to push you through the funnel, right?
Totally.
And so the process for that was you're supposed to create a big investor list of kind of people that match your startup and they're interested in your industry or maybe interested in your type of product and are interested in your stage, right? So we create this big list, and then we go through LinkedIn, we go through our founder friends, and we kind of try to find who could introduce us to those VCs. Then we send to our introducer, we send a blurb. They forward that blurb over to the VC, and if the VC says, yes, I'm interested in talking, then they opt in to meet. Is that a fair description of the process?
Exactly.
Yeah.
Yep.
Okay. This is a huge amount of work administratively. And it's super inefficient, especially because what's happening to me right now is that I'm working with a bunch of founders who are all asking me for blurbs. So I'm probably sending 40 blurbs a week.
That's my job, Blake. Now you know my life of the last.
Yes, exactly. Yeah.
That's all I do, like blurb monkey, like intro monkey.
Yeah. And so I guess, my big question is, why does this suck so bad? So I think first off, maybe can you rephrase? So the problem for this founder is this is horribly inefficient, and it feels like there's some better way to do this. Can you talk about it from your standpoint, like systemically? What's the problem from the VC's perspective? Or even systemically, what's the problem overall? Yeah.
There are 2 things that you're achieving with this top of funnel method that you've described. So one is finding the right fit. And I think every investor, even if they are generalists, have things that they like and don't like little quirks or things they gravitate towards. So for me, for example, we've done a lot in health, fintech, and B2B. Those are very broad categories in themselves. But I think the flip side is I often have people saying, oh, I love how you're such a prolific consumer investor. And the reality is, if you look at my deals, I have very rarely done a consumer deal, even though I've looked at so many. So we all have different things we gravitate towards, and that's not very clear on people's websites. So that's thought number 1. So you need to just have top of funnel to even just filter out who is even remotely interesting both ways. The second thing is in creating FOMO. And this is where all the song and dance about running a process comes in. But I think when you think about it from, I don't know if it's a game theory perspective, but something along those lines, where if I, as an investor, have the opportunity to invest in this same company at the same terms 6 months from now, it is always better to wait for more information, right? Like, there's no reason from a logical perspective for me to invest today, except if I believe that I will not be able to do that 6 months from now. And that is where the FOMO part comes in. So it's not so much that, yes, there are a lot of assholes in VC and there are a lot of asshole investors, but I think part of it also is from a logic perspective. That is why FOMO is so important, because everyone, if you put yourself in the shoes of an investor, everyone, just logically speaking, will want to wait. So those are the 2 things you kind of need to achieve from this, and that's where this whole process comes from. But I do actually think that there are things that can make the process more efficient, and especially in this day and age, compared to even when you were raising money several years ago, a lot has changed. Still have a ways to go, but I think there are ways to make the process more efficient today.
Why don't you talk about that? That'd be really helpful, actually.
Well, so one is cold emails. I think more investors these days are willing to take cold emails. Newer VCs certainly are, because when you think about it, like, their job is to invest money. They need deal flow. It's not like, investors don't need to see startups. They need to see a lot of startups. So they need deal flow. And so a lot of investors these days are willing to look at cold emails. So you can skip the introduction phase. That's thought number one. Thought number two is, before, when people were driving up and down Sand Hill Road to do meetings in person, all that driving takes a lot of time, and you have to dress up and you have to get out of your car or whatever it is. And in this day and age, I have founders who are pitching on Zoom all day, and they can do 50 meetings a week. And I have never been able to do 50 meetings a week, like when I was raising money, right? Like you could, at best, with traffic and everything, maybe do 20 if you're good, or if you can cram some in, like early breakfast or late evening, then maybe it could work. But 50 is, you can do more or less back to back on Zoom, and that is way more efficient than things were even just call it 6 months ago. And that's something that I think VCs are getting used to in their workflow now, in a way that they were not in May or certainly March.
Can you talk about what a quality cold outreach might look like versus a not quality cold outreach?
Yeah, so a lot of people say that cold emails don't work, but I think really what doesn't work is bad cold emails. And so, just for reference, 15% of the deals that we've done have come completely cold. So as in, we didn't know the founder, we didn't have a referral from anybody. Like, it was just founder reached out to us and we took a meeting and we invested. So what does it look like? Concise. Investors don't have time to be reading long essays. And basically, what are the most salient points of your company? So maybe you have a line to build rapport, and then maybe you have 2 or 3 bullets about like the key things about your company. So if you have domain experience as a founder in that particular area that you're trying to solve, definitely mention that, like you're an expert. If you have any traction at all, and it doesn't matter if it's just a little bit. In fact, actually, most companies that I see are, sort of at the idea stage or product stage. So if you have traction, you're actually probably standing out over most companies. Or if you have pilots, even if it's not revenue, stuff like that, things that will give you social proof. If you've been in the press a lot, also tout that. So just 2 or 3 bullets, and then a quick call to action, like, what is the best way to chat for 20 minutes by phone or Zoom or something like that. That's it.
Who does that email go to? To whom does that email go?
So another mistake is to send it to every investor at a firm, because what ends up happening is, even if people think, oh, that's scrappy, my business partner will take care of it. And then of course nobody does. So you have sort of the tragedy of the commons in that case. So I would just shoot an email to one person on the team, ideally the person who is most relevant. Now, it still takes some work to do some research, but if you are pitching a generalist firm, there's usually like somebody in the partnership who specializes in this and somebody else who specializes in that. So for example, my business partner, She & Co, pretty much only does fintech deals. And so if you have a fintech company, you probably shouldn't be cold emailing me, although I'll take it. You should probably be cold emailing her. So if you can just do a tinge of research around like who in the partnership do you want to work with, like which individual do you want to work with, not which company do you want to work with, just shoot an email to that person.
That's really helpful. Yeah, I wonder, it shifts the workflow, right? So now the workflow is the research to find the right partner instead of the research to find the warm introduction to the right partner. So that's a big win. That's helpful.
Research takes a long time, and I don't have a great way of streamlining that part. I think the communications, like the meetings and, getting your emails there faster, I think those pieces have been streamlined, but the research part, I don't know how to crack that, because in all honesty, like I said, it's also about fit. It's like founder investor fit. And I don't know how you streamline that. I mean, I know NFX is trying to do some things by, categorizing how investors, invest or whatever. But like, if you look at my own profile, it pretty much looks like I invest under the sun, which is kind of true, but it's kind of like, if you were to really slice and dice, you as a person would find patterns around things I like versus how the categories have gone.
Yeah, maybe could you talk more on, so NFX, DocuSign, so Mike Pruitt at visible.vc, he started to build something. Like, I feel like a lot of people are starting to build these kind of networks and introduction networks. You also have individuals who you can pay to shop you around. Talk about like current solutions, pros and cons with those. I know how you feel about some of those.
Well, I don't like the pay to plays. I don't believe in that. Obviously
the way I describe it is that that's against the founder's code. If you meet someone who says, pay me to make introductions, leave that person alone, because that's not what real founders do.
Yep. Yeah. But that being said, I mean, some of these other things, Mike Visible, Lolita Taub has been doing, like, she has a matching tool. First Dollar Deals is also doing a matching thing. So there are a whole slew of matching things. And actually, I think that is a, a really cool thing that has happened, I would say more or less recently in the last year or even last few months, where you can now more efficiently get to investors. And I think describing some of these things a bit more, like Lolita's matching email, basically, like I as an investor get a list of companies every week, and then I can pick which ones I want to chat with. So it's like faster for me because I get to see 10 all at once. I don't have to send responses to the ones I don't pick. And then those founders can basically just submit once and get in front of tons of investors. And so when you get the meeting, it's already vetted in a couple of ways by both founder and investor and Lolita herself as well.
So you do you feel pretty optimistic on those types of technologies over time, you think?
I think that is a good way of doing it. I don't think it's going to be the only method because, I think here's part of the problem. Certainly cold email and matching programs like this are effective, but I think there's a whole slew of startups that also sound better over video or at a demo day or when you meet a founder at a conference in person or at an event or whatever. Like, there are going to be different communications channels that work more favorably for different people based on what they're working on and based on their personalities. And so I think these are just some tools that help, but I think that people will need to take advantage of all tools, like networking at events, taking advantage of demo days of all kinds, whether it's with an accelerator or a program like Google Entrepreneurs or whatever. Just like try everything in your toolbox.
Yeah, I think that's helpful. I'm trying to draw the analogy of like publicly traded companies and how they relate to investors. And it's kind of an interesting thought of like Procter and Gamble isn't sending their blurb to a bunch of investors saying, please invest in us, right? What they're doing is they're running their business and then they have a massive press arm, right? That's essentially hyping them up. And then they're also publicizing their results. And by publicizing the results and having a lot of good press around them, that tends to make more people want to invest and their stock price goes up. I wonder if that's an element that maybe a lot of founders are forgetting, is that you can do you can publicize, the more you promote yourself, the more investors are going to come to you, right? Do you think that that's an approach as well? Or do you ever do that? Do you ever reach out to people based on something that you see in TechCrunch or see in the news or something like that?
I have reached out to startups before, usually startups whose products I've been using. So actually, here's an example of a loss. I actually tried to pitch the founder of Calendly on joining 500 because I was a big fan of using Calendly and still am a customer today. He ultimately turned down my offer, and that's unfortunate because they're now doing 50 million in revenue every year. But that is an example. Like, VCs will often pitch themselves to products that they use or whatever. But of course, that then benefits products in sort of the VC or investor space, right? If you were doing something completely left field that a VC doesn't care about, then you can't use that.
Mm-hmm. Yeah, I used to always say that my next startup, because I was doing a fashion startup before, I thought my next startup, I want to sell something specifically for venture capitalists or their family members.
Yeah.
Because I thought that would be the best way to get in front of them.
I mean, I actually think there's a lot of truth to that, for better or for worse. I mean, investors tend to gravitate towards things that they use and they like and that they can relate to. And this is why things like fashion or e-commerce or whatever, those companies have a much harder time.
This is, so we've talked a little bit on the, I guess on the founder side of what we can do differently. If you were to speak to your fellow venture capitalists, what do you think needs to change in terms of behavior, or what things would you like to see people change in how they're approaching startups or being approached by startups?
I don't think we'll see behavior changes in existing VCs, but I think what is very interesting is sort of the up and coming new VCs. And it's from a couple of fronts. So one is there are a lot of people now starting new firms. But then I think the other thing that happened, even just a month ago, is AngelList, rolled out their rolling funds program. And that's very interesting because that basically allows anybody to start a fund and publicly market that fund, which is actually huge. One of the reasons why it's hard to start a VC firm is you're not allowed to actually publicly market your fund in most cases. And there are a lot of nuances that I won't go into. But AngelList has, they've been working with the SEC, and they have their team of lawyers, and they've structured this accordingly. And so anyway, the long and the short of it is we are now seeing entrepreneurs start funds. I mean, they always have for a while, but like with this, it makes it easier to start a fund and just have anybody write a small check in their fund. And so I think you'll just see many more investors, which I think means that there will be more competition, which will drive, faster behavior, quicker decisions. You'll also see more funders in places that we traditionally haven't seen funders as well. At least that's the hope.
Yeah. Well, that is hopeful. And I think that you're a good example of that. You've gone from being a founder to running 500 then running the Hustle Fund. And I feel like that DNA, you can tell that DNA. I feel like you are kind of a part of a new era of VCs in that sense.
I hope so. Thank you. But yeah, I mean, that's exactly what I would want in an investor, whom I were considering back my company. Like I would take money from former entrepreneurs or current entrepreneurs, like people who know how to run a business, have been there, understand the ups and downs, and mostly the downs, and can have patience as well as like be more entrepreneur friendly in their ability to move quickly and make decisions.
Yeah, that makes a lot of sense. Cool. This is really helpful. Any final words of encouragement for entrepreneurs as they're starting to do this?
I think fundraising is just always a drag, but just keep at it.
Hey, I hope you liked that video. If so, maybe watch another right here. Why not? Also, make sure to hit subscribe down below. Thanks for watching.